guys have been wondering, the markets lately have been swinging like a bungee cord. One day up, the next day down. And it got me thinking, should I even be investing right now? Maybe I should wait for things to settle down. But then I realized, waiting for a perfectly calm market is like waiting for a unicorn. Volatility is part of the ride. It's not a bug, it's a feature. So let's ask ourselves the classic question, SIP or lump sum in a market like this? Let's break it down step by step. A systematic investment plan or SIP is like putting your investments on autopilot. You invest a fixed amount regularly, which can be monthly, weekly, whatever works for you, and let it do its thing over time. You don't worry about catching up the perfect amount. Let's be honest, nobody consistently gets timing right anyway. Now, sure, if the market crashes and you really believe it's hit rock bottom, a lump sum investment can be tempting. But trying to call the bottom, that's like trying to catch a falling knife, right? Blindfolded. Not fun. Definitely not fun. Now, this is where SIPs shine. They use something called Rupee cost averaging. Now, what is this? This is when you buy more units when prices are lower, fewer when they are high. Over time, this smooths out the cost per unit. Here's a simple example. If you invest 1,000 every month for 10 months, you'll end up buying different values of mutual funds. The actual average purchase cost through SIP is often lower than the average NAV of the mutual fund over time. Now, this is the beauty of Rupee cost averaging. So basically, you try to average out the volatility of the market. Now, if you're worried about flexibility, you can pause or stop your SIP anytime. It's not a lifelong commitment, but here's the thing. SIPs often reward consistency. Like the tortoise in the race, slow, steady, and wins over time. Now, let's talk about fees. SIPs often come with expense ratios and some transaction cost. But usually, all of this is built into the NAV. Just avoid funds with hidden charges and stuff. But other than that, all mutual funds work in exactly the same way. Now, here's a key lesson. Don't stop your SIP during a market crash. That's when it's doing the most heavy lifting. People lose money because they buy during peaks and sell during panics. Keep your SIP running, get some extra cash during a dip. Great. Use that as a lump sum top up. But don't stop your SIPs. Now, moving on. Let's say you have a large lump sum in place, but scared to invest all at once. Use an STP or a systematic transfer plan. Think of STP as a SIP for your lump sum. You park the money in a low risk debt fund and then transfer amount regularly into an equity fund. It gives you gradual market exposure, like dipping your toe instead of jumping into choppy waters. Now, what do you do when you need money regularly, say during retirement? There's always something called a systematic withdrawal plan. It's the reverse of SIP. You withdraw fixed or flexible amounts and the rest of your investment continues to go. So yes, these tools aren't just jargon. They are strategies to manage volatility and help meet your unique needs. SIP helps you to stay consistent. STP helps you to ease into the market. And SWP helps you to exit smoothly. Depending on your need, each of these strategies can be put to use. Now, to sum it all up, the bottom line, SIP or lump sums. Both have their place. SIP is like planting seeds regularly. Lump sum is like planting a tree. Just don't plant it on a volcano. If you're not a market timing genius, SIP is going to be your best friend. You don't need to catch the bottom. You just need to stay invested and be consistent. Volatility will shake prices, but very often than not, discipline usually builds wealth. Now, if you're someone who's overwhelmed by market volatility, keep calm and speak to a financial advisor or an investment planner. Connect with us to build a plan that grows with you no matter what the market's been doing. So what are you waiting for? Use the link in the description to get into contact with us. Someone from our end will be in touch with you. Thank you.